Okay, welcome traders. Good evening once again. Good afternoon. I trust everybody's well. I think we can get into it. Today's Thursday. The time is 6:41 p.m. South African time. We did say today we continue with the theme of monetary policy, but focusing on interest rates and inflation. Okay. Are there any questions or comments regarding what we've covered or anything to do or related to the markets? Come. If you don't ask, means you know it all.
Do you personally trade news or
Uh,
just swing?
that line is not clear. Try again.
Do you personally like trade news, like Tsona NFP and everything? You trade them, or maybe you just know how they work.
I do trade them, but I'm not compelled to trade them always. It's not always that I will engage the data upon its release. How can I put it? Let me just accept everybody. Mm, that. Remember, yesterday we made examples of how to engage the data. I said what I entertain is completely disappointing figures or surprising numbers. Remember?
Yes, yes.
Do you? Are you
Yes,
there?
we remember.
Okay,
Yeah.
right. So yes, to answer you, I do engage that data, but I'm not compelled to because sometimes you'll get a situation like last week where you get a lot of volatility and the market is choppy, lacks direction. This is where your account takes a knock. Okay. So yes, simply to answer you, I do trade the data, but it's not always. It's not always. And if I have a strong bias on a particular currency pair or whatever it may be, I may front run that move. Do you all understand what front running is? Front,
No. What is that? Explain it.
You mean carry trade?
not quite. A carry trade is when you take advantage of the interest rate differentials between two economies. For example, the US with interest rates sitting at, well, now sitting at 5%. And let's say Japan, JPY sitting at only 0.25%. I would be looking at a possible carry trade there, right? So we carry trading is taking advantage of interest rate differentials and not only just interest rate differentials, but also taking advantage of policy divergence, right? When those two countries are employing two types of, or two different rather, monetary policy, right? One might be dovish, one might be expansionary. Sorry, one might be dovish, one might be hawkish. Does that make sense? So that is what a carry trade would be. Front running is when we are ahead of the move. This is also known as buying the rumor and selling the fact. Does that make sense? Give me a second. Let me just change my position here. Okay, sorry. Thank you. Yeah, front running can also be described as buying the rumor, selling the fact. Is that something that you've heard before? Buying the rumor, selling the fact?
No,
No,
first
no,
time.
no.
We don't know what that is. Oh.
Okay. All right. So let's say, based on your analysis and the data that you have at your disposal, there is NFP coming up, right? There's NFP coming up on the first Friday of the month, as we said yesterday. You'd be looking at a lot of maybe labor data, including other macroeconomic data, right? That may lead you to the conclusion that there's a high probability that the next NFP data may come out, for argument's sake, weak as well, or weaker than the previous month. So when you look at the technical picture, or should I say price action, all you're simply doing is looking for that entry opportunity to do what on, let's say, a chart such as GBP USD. What would you do with that chart? If you have a strong inclination that NFP data, that labor data coming out of the US, is likely going to come out weaker than the previous month, what type of trade opportunity would you want to entertain on GBP USD?
Yeah. I would look for a buying opportunity.
Right? You would be looking for a buy on GBP USD.
Yeah.
So now this is not looking for a buy upon the data release. You're already looking for that buy opportunity ahead of time, ahead of the actual NFP event itself. When you do find it, you are front running the move. The whole intention of that is to be ahead of it, right? So come NFP, you may already be in reasonable profit, and that trade may have given you a series of higher highs. Only if that is the general sentiment by the big boys and girls, only if they too have a similar point of view, such as yours, then they front run the move. They buy the rumor and then they sell the fact. I'm sure you've seen this before, where you know the data means that you should be selling a particular currency, but it doesn't sell upon its release. It actually buys before selling again. And then you think, oh no, this must be some manipulation by the brokers. No, it's not. You're just not in the know. Right? So when the data actually comes out to be just as anticipated, then all you simply do is you take profit. So what I'm saying is you may have bought here entry. The market may have moved by already 300 pips. Okay. And when the data does come out to be as you projected, all you're doing is looking for fair value. You consolidate those positions. You're closing some of them. You look for fair value. So the market then sells, only to find fair value and then continue with the move. So as a retail trader, upon the data release, you are buying here, but the market is doing this before doing that. That's what causes those whipsaws sometimes on the charts. Right? So if you entered here at this point, and the market, yeah, is somewhere there. Sometimes you may not have. What's going on here? Give me a sec. Okay, there we go. It's back. Sometimes we don't even see the profit taking. It just pushes even higher in your favor. You've already been in a trade. And by the way, like I said yesterday, the data that is much anticipated, that has a lot of attention, which is NFP, it doesn't move by a lot. It's no more than 200 pips. So in the bigger scheme of things, people are making noise about a range this small, yet you've been in a range this big already. So when everybody's saying, oh, did you see NFP? Oh, it moved there. We made a lot. You've been in it already. It's nothing to write home about. You follow?
Yes,
Yes.
we follow. Where do we get the rumor? Maybe that's the next question.
The rumor, like I said, would be based on your analysis of the fundamental data leading up to the event. Then you formulate your own bias and prediction that this is the likelihood of the data coming out this way or that way. Right? For example, let's use NFP. Fine. Let's use NFP. Leading up to NFP, what type of data do you want to look at? That might preempt how NFP is going to come out. That might predict, maybe let's use that word. And prediction is just that. It's a prediction.
Employment data. Employment
data. What comes out before NFP? What employment data or labor data comes out before NFP?
Is it not unemployment rate, perhaps?
That is one of them, which is a weekly data set that comes out every Thursday. In unemployment claims. What is unemployment claims?
UIF.
Well, in South Africa, yes. We would call it UIF, right? So a little tricky for others who are, we would call it UIF, Unemployment Insurance Fund, right? Some may call it something else in different parts of the world. But yes, you're correct. That's what it is. Right? We've got unemployment claims. What else?
What about
ADP? ADP employment data. What else? Charles, jobs opening. Let's see which for now. So this may give you that rumor ahead of NFP. You are able to gauge or predict how NFP might come out based on this data. I'll add one more thing here. I would say the ISM data. ISM, of course, ISM PMI basically covers manufacturing and services. Now, these two also gives us insight into the employment dynamics or the dynamics of employment. How did we get here? I've completely forgot. How did we get to this now?
You asked a question about, do you trade news?
Oh, yes. That was the question. Okay. Yeah. So I can either engage the data upon its release or can front run the move, right? And that's the type of data that I would look at to potentially front run that move. And I ideally like such trades. Less volatility, I get to ride it being, plus minus 500 pips ahead of the actual data. Now, if the data comes out to prove me wrong, well, I've already had a stop loss to protect the profits that have generated in the last couple of days. So it's not a problem. And I don't feel compelled or under pressure to be a part of that reaction in the market. I don't feel any pressure to execute a trade and engage that data. I was already in a trade. Now, if it comes out, of course, to prove me correct, it only just propels me even deeper into profit, effortlessly so, right? Effortlessly so. Any other question or comment? Please feel free. No question? Okay. Alrighty. So we said we're going to talk about, and I said we have to go back a little into time, right? We have to go back a little into time. And I said, of course, we're going to focus on the US economy mostly, but it's quite similar. The approach will be similar, if not the same, with other countries or currencies or their central banks. But before we go deeper into that, I think we need to look into this first. Developing a fundamental bias on a currency. So let us outline what is important and gives you some sort of guidance on how you're going to formulate that bias. So it involves analyzing a wide range of economic, geopolitical, and monetary factors that influence value in foreign exchange markets. Here's a step-by-step guide to developing a fundamental bias on a currency. Number one, understanding economic indicators. Familiarize yourself with the key economic indicators that impact the currency's value, such as GDP, inflation rate, employment data, trade balances, and consumer spending. Analyze how changes in these indicators affect the country's health and its currency's strength or weaknesses. So remember yesterday I did ask you, name some of those market moving macroeconomic indicators, and it involved some of these that I covered here. Secondly, monitor central banking policies. Keep track of monetary policy decisions. Keep track of monetary policy decisions and statements from central bank of the country. Pay attention to interest rate changes, quantitative easing programs, forward guidance, and policymakers' commentary on inflation, economic growth, and exchange rates. Understand how central bank actions influence currency valuation and market expectations. So these are the things that you should be monitoring. Does anybody know what quantitative easing program is? No one? Okay, we'll come back to that one. Forward guidance. Remember yesterday we spoke, or I introduced you to monetary policy and its tools. Name those tools for me. It was 4 of them.
Fiscal.
I beg your pardon?
Fiscal. I forgot what fiscal
No, that's fiscal policy. I want the monetary policy tools. The monetary policy tools. I'll give you one: reserve requirements. Reserve requirements. What would be the other one?
QE.
Come again.
QE.
Okay, what is QE? Because I asked it here.
Is quantitative easing.
You're just telling me what the abbreviation QE stands for. You're not explaining to me what QE is. It's like saying
Bond.
ABS. And that's all.
The bank buying bond from government, right?
Well, they always buy bonds from government. Yeah. But I need more. I need more. You are very, very, very warm.
Is it not interest rates, managing interest rates?
I think it's when their bank try to add more money to they add more money to their reserves.
Okay. Close. Very close. Very close. I'll explain it for you. Right?
Quantities. Can I try one?
Yeah.
Yes. Is it not those programs whereby the government had to bail out these businesses that are necessarily needed in the community or something like that?
Yes, that can be done under QE. Yes, that can be done under QE. Also very close. I would say none of you are wrong, but you're not quite, getting into it as much as I want you to. Right? So we'll come back to QE. But it is part of, monetary policy tools that are used. Reserve requirements. Okay. Let me go easy on you because it's Friday Eve. I'll give you an opportunity to do your revision. This has to be part of your DNA, this information, right? Just like when you can call me anytime and I'll tell you what price is doing on most of these charts. Any hour of the day. That's where you need to be. Right? Should be able to tell you what structure we've been trading in the intraday on higher time frames and tell you exactly what are the targets for bulls are and for bears off the top of my head, because you're engaging this data on a daily basis. Okay. Forward guidance. So we mentioned about 4 monetary policy tools yesterday. Forward guidance is one of those. This one here. Forward guidance is one of those monetary policy tools. So it's not the oldest monetary policy tool, but is very efficient and has been adopted by many central banks. What forward guidance is central banks communicating much more clearly and early on their point of view and their intentions. And this is timely as well. So they will tell us this is the state of the economy. This is the data that they're looking at. This is where they see the economy. This is how they think they can get there. So they give you an idea of what type of monetary policy is going to be implemented to achieve their objectives. You follow? This helps the broader market to digest this data so that we don't have any shocks in the market, basically. So we are able, ahead of time, before the actual central bank implements a particular move or policy, it gives us a chance to digest and interpret this data and actually price it in. And when the actual decision is made, it's not going to cause a lot of financial instability or volatility, if I can put it that way.
Okay.
Right? So those are the things that we need to pay close attention to. So we need to be watching those headlines, going into their websites, getting that forward guidance. Also, on their websites, we're going to see policymakers' commentary as well, right? We're going to hear those board members that are decision makers from the central banks on their individual capacity. They attend various summits and events, right? And they do get asked what their opinions are on the state of the economy, the global economy, and so on and so forth. So that does, to a certain degree, impact the markets. Alrighty?
Thank you. Understood.
It's just like last week, Thursday. I think when it gets to Thursday, you're all dead. All dead. Come on, it's month end. Should be much more happier, I guess. Right? Analyze trade and current account balances. We will look into these. Examine trade balances, current account deficits or surpluses, and capital flows. A country with a strong export sector and a surplus in its current account tends to have a stronger currency, while persistent trade deficits may lead to currency depreciation. Yeah, sure. What are they talking about? Right? Of course, no country is an island. Well, I think you understand what I mean. There is something that we need from another country and the things that they need from us. So it's all about international trade. Those who have their goods and services in much higher demand, they would have a higher export rate, and they're likely going to have a surplus. In other words, what that current account surplus is that it is showing you that this country exports more than they import. You're going to see that day trading economics here. For example, Japan and China export a lot. They're likely ground. There it is, 1.5. Japan, 3.6. They export more than they import. Is it nice and clear?
Yeah. Okay.
Now, there are countries who import more than they export, but that doesn't necessarily impact their currency that negatively. What countries can you think of? Let's name two. They are likely importing more than they export, but they still have a relatively stable and strong currency valuation.
United States.
The United States, indeed.
Yeah, of America.
The United States as well.
Russia,
Not quite. The United States is up there, definitely. They import more than they export, but they've got a sizable services sector that brings in quite a lot of capital inflows into their economy. So there's a trade-off of some sort there. It kind of balances.
I think in Africa, Lebo, I think of Botswana. I think it is one of the strongest currencies in Africa, and it imports more than what it exports.
Yeah. Right. You don't have the strongest labor force out there, but because of, I guess, the diamond industry, it kind of balances off, right? Kind of balances off. But it won't last forever, and something needs to happen there. I did attend a summit a couple of years ago when is it Masisi came into power?
Yes.
Yeah. So they definitely do recognize that that industry is going to die out, and they need to have or develop, other industries within, that border. One that also comes to mind is the UAE. They are known for their oil, but the oil doesn't really contribute much in this day and age. Then, yes. Now they import pretty much everything. It's a desert, right? Food, labor, everything is imported.
Yeah.
Yet their currency is relatively stable because of their services sector, just like the US. Very similar economic setup there. Righty. Where are we? Consider market sentiment and risk appetite. Take into account market sentiment, investor risk appetite, and global market trends. Factors such as risk aversion, flight to safety, and market volatility can impact currency flows and exchange rates. Safe haven currencies like the US dollar and the Swiss franc may strengthen during periods of uncertainty, while riskier currencies may weaken. This is something that we spoke of as well yesterday. Geopolitical events may bring about a change in risk appetite and sentiment. Stay informed about external factors. Stay updated on global economic developments, major news events, geopolitical tensions, and market-moving announcements that can influence currency markets. Events such as geopolitical conflicts, natural disasters, central bank interventions, and changes in commodity prices can have significant effects on currency valuations. I'm yet to go back into charts to show you examples of these as well. Central bank interventions. This is something that the Bank of Japan tends to do. Natural disaster. There was one in Japan as well. That earthquake, you remember?
Yeah.
Geopolitical conflicts. Well, we know of the most recent one, Middle East, and one that, well, it's recent, but not so much, Russia versus Ukraine. Combine fundamental analysis with technical analysis. Integrate fundamental analysis with technical analysis techniques to validate your bias and identify potential entry and exit points in the market. I've always said, you can't do with one and not the other. You can't pick and choose when it comes to trading. Now, some traders will say, I'm a technical analyst and that's where it ends. I don't, look into fundamentals. But even having that type of stance, they would very much agree with the point of the fact that fundamentals are extremely important, because if they weren't, then they wouldn't be staying out of the market when we have high impact data such as NFP. They would just simply place a trade at any given point in time and not worry about such events. So what I'm saying is your technical analysis may be great, but your trade decision needs to be fundamentally sound, right? So you may look at a chart and identify a structure, etc., but you need to back it up with fundamentals. You need to back it up. You need to be able to reason why this trade will go this way. And I must say, employing these two, fundamentals and technicals, gives you high probability setups and you trade with much more confidence. So you are willing to stay the course when you execute trades. Normally what makes you uncomfortable is the lack of information. You don't have enough reasons why you should be holding on to this trade. And so you can't even sleep through a trade. Does that make sense?
Yes.
Mm-hmm. So if you've got all the facts, the more information you have, the better the decision making, and you are able to sleep through those trades. Regularly review and update your bias. Continuously monitor economic developments, news updates, and market trends to reassess your fundamental bias on the currency. Stay flexible and adapt to changing market conditions, adjusting your bias as new information becomes available. By following these steps and conducting thorough research and analysis, you can develop a comprehensive fundamental bias on a currency and make more informed trading decisions in the foreign exchange market or let's say for any other financial market sector as well. Any question? No question? Okay. Please give me, say, 2 minutes. Okay. I just need to quickly rush across. Let's not have this awkward silence. Talk amongst yourselves. I'll be back shortly, just now. It's a tea break of some sort.
Let's talk, brothers and sisters.
Hey,
Let's talk about something.
what can we talk about? Hey?
Yesterday, I heard you talking about entries, and am I right?
Entry. Yes.
Yes, you were saying maybe sometimes it sweeps your stop loss too much or something, like many times, sometimes.
Oh, yes. Yeah. No, I was saying that because of this risk management, I'm actually struggling with the stop losses because sometimes the stop loss, you think you should put it where support is, or just after support or after resistance. But then sometimes it opens
triggers the
the
stop loss.
gap.
Sorry, I didn't quite hear you.
No, I'm saying when I put in the stop, remember when he talks about risk management, he always talks about 1-to-3 ratio.
Yes.
But now I was saying I'm struggling to manage that when I look at, where to put the stop loss, because in my mind, a stop loss should be after support or after resistance, or above resistance or below support.
Yes.
Sometimes that is too close, or sometimes that is too far. And now you think, how do I I still want him to clarify that 1 to 3. How does one manage that?
Okay, it kindly says, according to my knowledge, ne, 1, 2, 3, 1, 2, 3, ne, you are willing, if maybe you have 100 rand, you are willing on that 100 rand, you are willing to lose 20 rand to make 40 rand. Do
Okay,
you
that
understand?
would be-
That is 1 to 2.
That's 1 to 2, yeah.
Yes. Then if you are
Okay.
willing to risk 20 rand for to make 60 rand, it's 1 to 3.
And that
So
makes you profitable.
yes. Because of like most of the time you will realize that most of the trades, maybe if you take 5 trades, ne, you can lose about 2. It's still okay even to lose sometimes, but when you lose, you will be losing 20 rand rather than losing 60 rand. But when you are winning, you are winning 60 rand
I'm back.
rather than okay.
Sorry. Yeah,
Other than
you can finish your point.
yeah, we're talking
Okay.
about 1 to 3. Yeah.
Alrighty. Thank you for that.
Yeah.
All right, let's get into interest rates. Right? Interest rates. Interest rates are a crucial tool in monetary policy and have wide-ranging effects on an economy. Here's an overview of how interest rates affect various aspects of the economy. So I think we all have a general understanding of what interest rates are. I think it affects our daily lives, right? I think for an layman, nobody appreciates high interest rates, right? I think that point we understand. But let's dig in a little deeper. Consumer spending and savings. If you have high interest rates, this encourages saving, right? High interest rates encourage saving. I think at one point, a country with the highest interest rate was Turkey. It was Turkey. I remember, I think it was Turkey. And that was kind of what really sustained the bulk of their economy.
Nigeria is not the highest interest rate country right now.
Who's that?
Nigeria.
What's your interest rate?
Crazy.
What's the percentage there?
I think 21 or so, I'll be 25. So they even increased it of recent again.
Yeah,
So these people, they are crazy.
Yeah, I know that's extremely high. Yeah.
They are worthless currency.
Wow. But I can tell you one thing. The savings rate isn't high. It's meant to encourage saving. But
yeah,
saving is a luxury. Right? Saving is a luxury. And I'll show you examples as we go back into time with the US economy, which is very similar to, and the same thing, or a similar thing also pretty much happened with all other economies, especially developed economies, right? We will look at their savings rate and how it played out. So yes, high interest rates encourage saving because higher returns on saving account, you get higher returns on savings accounts and other interest-bearing investments. Incentivizes people to save more. This discourages borrowing. Loans and credit becomes more expensive, reducing consumer spending on big ticket items such as homes and cars. And of course, low interest rate would mean the opposite. This would encourage spending. So yeah, sure. 20% would encourage me to keep some of my money with the bank because while I earn an interest, if a nice interest on that, and I don't have to risk my money to get high returns because, well, the interest rate is high. So in other words, when you have high interest rates, we will see a rotation out of the stock market, which is high risk, high reward, and into savings. In other words, bonds, if I can put it that way. You follow?
Yeah.
Yeah. So this is one very popular monetary policy tool that is used by banks, right? Because they can regulate the economy with just this one monetary policy tool, interest rates. Hike the interest rates, you slow down the economy. And the actual hiking of interest rates affects the money supply. How would it affect the money supply? Anybody? When you hike interest rates, what does that mean?
Lower money supply.
I beg your pardon?
I said with high interest rate, it tends to encourage saving, so you have a low money supply.
Aha. The money supply decreases, which equals to what happens to the value of the currency? Does it go up or down?
Up.
The value of the currency goes up. The value of the currency goes up. You hike interest rates, you are reducing the money supply. You're taking money out of circulation. The less basic economics, the less of something that you have, the more valuable it becomes. And so, therefore, for example, this is how the currency would look like because of high interest rates. In other words, when you hike your interest rates, the value of the currency also does that. And of course, vice versa. You lower interest rates, it means you have increased the money supply, which means the value of the currency goes down. Nice and clear? Nice and easy?
Yeah.
Right?
Yes, sir.
So that is one tool that is used by many. Hike the interest rates. Essentially what you're doing is when you hike interest rates, you decrease the demand for goods and services. Now for businesses, of course, let me just take this and put it here. Where am I? Am I here? Yeah. High interest rates increases the cost of borrowing. High interest rates make it more expensive for businesses to finance new projects and expansions. This reduces profitability. The higher cost of capital can lead to reduced investments and slower business growth. Lower interest rates, lower borrowing costs, businesses can finance projects at lower cost, encouraging expansion and investment. This would increase profitability, and lower capital costs can improve business profitability and foster economic growth. Now, what impact does this have on inflation? High interest rates can control inflation by reducing spending and borrowing. High interest rates can help cool off an overheated economy and bring down inflation. Low interest rates stimulate inflation. Increased borrowing and spending can lead to higher demand for goods and services, potentially pushing up prices. On the exchange rate, high interest rates attract foreign investment. Higher returns attract foreign investors, increasing demand for the domestic currency and potentially appreciating its value. But it's a double-edged sword. We've just spoken about Nigeria, Turkey. It's a trade-off for Turkey, right? Because they get a lot of foreign direct investment, but they equally have a strong services sector. It's known for its tourism. It's known for its beautiful landscapes, etc. So, of course, with such high interest rates, foreign direct investment would increase. Does that make sense?
Yeah.
Okay.
Yes.
It can also affect employment. High interest rates investment can lead to lower demand for labor, potentially increasing unemployment. Let's stop it right there. If you remember at the start of the COVID, a lot of people were laid off or were told not to go to work. Eventually, with the rollout of the vaccine, the economy started to open up, the global economy, right? But the damage was done. So how would they bring about an increase in demand for goods and services? They would lower the interest rates so that people have got access to cheap money, credit, loans, because that's the world that we live in right now. That's how the global economy is set up. It's what makes it, move is basically credit. We live in a credit world right now. So if you can generate cheap credit or get access to cheap credit, you are able to then finance your plans, whatever that you have, your projects, right? As a household, I might go to the bank and say, listen, I'd like to borrow X amount of money. I want to renovate my house. I want to go on holiday or whatever the reason may be, or I want to buy a car, a house, etc. Right? This money can also be used for various things. Like I said, if you're on holiday, you like to go to eat out at restaurants, etc. And so, of course, if the demand increases, those restaurants would want to expand on their capacity, on their labor force capacity, right? So employment would increase. If nobody's going to these restaurants, if everybody, let me put it this way, if everybody is good at saving, there wouldn't be an economy. That's why you're not going to hear anybody encouraging saving, honestly. If we all got good at saving, then we wouldn't have much of an economy. Am I making sense? We would find ourselves in a disinflationary situation, such as Japan, right? Where people don't go out anymore as much. They have a serious problem actually in Japan. It's a social problem. People don't go out anymore. People are pretty much depressed. The social, how can I put it? Build up there isn't the best. Everybody keeps to themselves. They don't spend much because the future has been uncertain for that long. It has almost become a part of their culture or nature, if I can put it that way. That didn't or doesn't help any economy in any way, right? And that's why you would never hear any government or central bank encouraging, saving. People need to get employed or run businesses, spend money. The money that I earn, I need to go and buy bread. I need to go and buy, goods and, services with it. And wherever I'm spending my money, they will increase also their labor force. They too, of course, like myself who gets taxed, they would also get taxed. So, like I said, if everybody got good at saving, how would the government then also finance their fiscal policy? Because their tax earnings would be, or would dwindle rather over time. Are you able to see the picture that I'm trying to paint for you?
Yeah.
So spending is crucial for the economic wheel to turn. I need to pour petrol, I need to do this, that. And all this can be stimulated with just interest rates.
Can I ask a question then?
Yes, sure.
What you are just saying now, am I correct in saying what US has done by cutting interest rates, it might impact on the future NFPs, how they look?
100%. Cutting interest rates is very much an accommodative or an expansionary monetary policy. They're trying to stimulate that economy.
Okay.
Right? Remember, for 4 years, those interest rates haven't been cut. The last interest rate cut was back in 2020. Right? So now we've had those interests. So it will always, central banks will always try and find that equilibrium. Right? We have times where the economy pushes up and then they say, okay, hang on. We don't want it to get out of hand. So what we do, we hike interest rates at this point. The economy slows down. Hang on. We don't want it to slow down too much. What do? We lower the interest rates. It picks up again. You get the point. Is this making sense? They're always trying to regulate the speed of the economy, the speed of things. Right? Okay. So let's try and put this into context, because I think we've established the relationship between interest rates and inflation. Now, inflation, I've said, it's not always bad. What's bad is the inflation rate. Inflation you will always have. What is bad is the inflation rate. Okay? Now, most central banks have got a target for their inflation rate. Does anybody know what that target is?
2%.
2%. Don't ask me why 2, 1 or 3. It's just a thumbs up and people started going with it. Okay? But if somehow, for some odd reason, there's a paradigm shift or whatever it may be, and central banks just can't get to this 2%, then they might settle for the 3 if that's where it is. And this will be the natural state of inflation rate. This will be their new target. But for now, and what it has been for a couple of years, it's 2%. It's not always going to be at 2, and so that's why they have a range, right? Let's say for as long as it plays within the mid 1% the mid ones, let's say 1.5 and say 2.5. That may be understood or seen as normal because it's not going to stay constant. It's impossible. There's so many moving parts, so it will move within a range, and that's perfectly normal. Does that make sense at all? Are you understanding? Anybody? Anybody home?
Yeah, it's real difficult.
Okay. I don't think you're ready. I don't think you're ready. I don't think you're ready. I need that engagement so I know we're on the same page. I'm not losing you at any given point in time. Now,
On the same page, I'm just somewhere where I cannot that talk too much. That's it.
Okay.
But you can go ahead and follow. Yeah.
Okay, no, thank you. Now, inflation, of course, speaks to your buying power. I think we can agree on that. We were to explain brief in layman terms what inflation is. It speaks to your power, right? When I was young, like I said, I think it was 5 rand or 10 rand could buy bread and a sachet of milk. In fact, 2 loaves of bread and a sachet of milk, and we would get change back for some candy on the way back home during school holidays, right? Now, what, 40 years later is totally different, right? 10 rand doesn't even get you a loaf of bread in South Africa. Well, branded anyway. Branded.
I thought that really happened in Nigeria.
So that's inflation, right? Your buying power. So that's why also it doesn't make sense to keep your money in the bank because of inflation. If I deposit $100 in my account right now, what I can buy with this $100 today, next year, the same time, same month, this $100 won't afford me the same items that I would have bought today. It would lose its buying power. It would likely have a buying power of, let's say, 90. Maybe I'm exaggerating it a bit, but at the rate that things are going, maybe that's what it is. You still have your $100 bill, but it doesn't get you things worth 100 that it could have gotten you today. Right? So that's simply put what inflation is. Now, there are different ways of various measures of inflation. Let us talk about them one more time. We said, what are they? What are those measures of inflation? Or what macroeconomic data is used to measure inflation? Let me put it that way rather.
CPI, PPI.
CPI, PPI, right? So we're talking headline CPI and PPI and core CPI and PPI. We will make that differentiation between the two in a moment. We also have personal consumption expenditure, which is your PCE. That too is a measure of inflation, and one that is overlooked by a lot of retail traders. It's your ECI, Employment Cost Index, right? Your Employment Cost Index. What it is, it measures your labor costs, including wages and benefits, which can influence inflation if wage growth exceeds productivity growth. Right? And that's something that I think a lot of South Africans don't understand with let me say we've got a lot of what do they call them? Unions. I'm not one for unions. I don't believe in them, right? So yes, they say they protect, workers, etc. But in most cases, they anyway have a conflict of interest because they have shares within the same industry. So are you getting my point though? Like, let's say the mining industry, we've got various unions who say they're protecting the interests of mine workers. But the very same guys have got shares in the mining industry. We can even take it further. They've got shares within the same company. Do you think they're going to have your best interest when they meet with the board of directors of that mine on wage negotiations? When you send them to say, listen, we really need 11%, they're not going to come back and say, we got you 11%. They're going to say, comrades, we fought and deliberated the entire night. We haven't seen sleep. We spoke all night. We debated, and then you know what? We managed to get you 3%. And then next year you're gonna get 2 and 2 for the following year. It's the game that they play, right? Because, well, they have an interest as well. Of course, if they get you your 11%, it hits the bottom line. They won't get those favorable return on their investment. So what we're seeing in general, people are always asking for more money, yet the productivity is not increasing. And that contributes to inflation, which is inflation that we can definitely see in our country as well. Right? So employment cost index is extremely important. Don't take my word for it. I say it's important because central banks say it's important. Right? They may not say it in so many words, but they always make reference to it because that's the data that they're looking at. They wouldn't just look at it if it's not important. You see? So we have to always understand what data do central banks look at which inform their monetary policy decisions. Right? So we said we have, here's my pen, CPI. We said we have headline CPI. So this will be the normal CPI, Consumer Price Index. And then you get core CPI. What is the difference? Anybody? Yeah. Thursday, ne? Thursday is doing us wrong, Shem. Thursday. It's like a Friday. Core CPI. Excludes food and energy in there. Excludes food and energy. They don't measure that. So that's core. Now, your central banks love the core data. Why? Well, they say it is less volatile and much more reliable data compared to the headline. Are you following? So your central banks love this one, core data. So that's CPI. We said there is PPI. So you have headline, and then you also have core PPI. Core will always be their favorite too as a measure of inflation. PCE, the same. Core would be their favorite. Employment cost index is just that. There is no core. It's just employment cost index. Any questions?
Yes, I have a question.
Mm-hmm.
So when they release a data on core CPI, how long does it affect the market for? Let's say they release it on Thursday. How long will that data be valid for?
That is always extremely hard to say, honestly. It is extremely hard to say. The market can engage that data and price it in an hour, and then we go back to normal, or it could be something that is a talking point for days on end, and move the market for a couple of days. It is
Okay.
extremely hard to say.
Thank you.
But in this day and age, we understand that what the theme is, what's really moving the markets in this day and age, or what has been the central focus for most economies, has been inflation, has been this, including, of course, labor data. Right? Labor data can be a measure of inflation. Now, traditionally, it's not used as a measure of inflation. It may be used as a measure of productivity in an economy, but labor can be used as a measure of inflation. And I think that, or this thesis of mine, has been proven in the last 4 years by central banks, because they've been looking very closely at that data. Think about it logically. If you have inflation that is high and you're trying to get it down, yes, wages are a concern, what those people are earning. Because if they earn more, that means they have more money in their pocket. That means the aggregate demand for goods and services will continue to rise, which basically means inflation will stay stubbornly high. Nice and clear, nice and easy, lemon squeezy. Any question? Hey, either you confuse or you're impressed. One of the two.
Confused.
What is that?
Confused.
Confused.
Yes.
As long as I have an impact, that's okay. You must toss and turn the whole night. What was this guy saying? I don't understand. Other than say, oh, so boring. There must be an impact. Okay, think about it. If everybody gets an increase in your country, it's 100% increase. That means the money supply in the economy is increased by 100%. Just through wages. You follow? So that means I have more money. Now, we are all chasing the same goods and services. In other words, the demand for the goods and services increases. Inflation would go up. That is one way the labor sector can affect inflation. Now, not only just the wages, but also the employment, the labor force itself. If that increases, in other words, if people keep on getting hired and hired, in other words, there's an expansion or an increase in labor, then we have more people with access to money. That too will contribute to inflation. And so for the last couple of years, or let me not say for the last couple of years, let's say specifically for this year, we have seen a big focus by other central banks, but specifically the US, the Fed, on labor, right? They have made it clear through their forward guidance and other means of communication that they wanted to see unemployment rise. They didn't say it in not so many words, but they basically told us they want to see people lose jobs. Less people employed, less money in circulation. Less money in circulation, inflation comes down. Any question? Is this for a Thursday?
Good.
Okay, no. I think
Oh,
that
it's clearer.
all right. Clear to some. Some need to hear it more than once. And I've always said, don't be hard on yourself. Enjoy the learning process. Of course, it's new information to some of you. And so you need to hear it more than once in various ways. There are many methods to a sum. 1 + 1 is 2. 2 + 0 is still 2. We will still end up at the same place. Okay? So I encourage you to listen to or watch this recording again over the weekend and start doing research on these topics, because there's nothing that beats learning through research, because that's how I got to where I am. Because what you research on your own and what you learn, you will never forget. Am I making sense? Hallelujah.
Yes, you are.
Glory be to God. Okay. So let me not bombard you then with too much. This was just a taste then. This is the starters then. So what I initially wanted to do is go even further, but we will leave it here, right? Then when we come back on Tuesday, we will continue to talk about interest rates and inflation. We will look into inflation expectations and what that is and how to find that data, and basically how to find that those measures of inflation on your economic calendar. Then we're going to go into the central bank's website and go back into time and see how their monetary policy has evolved over time with the changes in the economy. Is that fair? Is that okay?
Yes. Yes, it is.
Okay. Now, I trust that you have enjoyed this evening's session and it has brought light maybe into something that you are not aware of, or clarity into something that you've been looking at or hearing about. Let us